Good afternoon, everyone, and welcome to the Cliffwater Direct Lending Index quarterly webinar for 1Q23. My name is Fran Byers. I'm the head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater, and the creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor founded in 2004. We're active across the alternatives investment spectrum, currently advising on or managing over $100 billion in alternative assets. Just a few things to note before we get started. This is the Cliffwater Direct Lending Index quarterly webinar. It's intended for our clients and investors, and we will not be discussing the Cliffwater funds on this webinar. This webcast is meant to be confidential, and it is intended for qualified and sophisticated investors. It is not meant to be an offer or solicitation for the purchase or sale of any security. The information and opinions we will discuss are not investment advice, and there is no assurance that any expected rate of return, risk, or yield will be achieved. The format for today's call will entail Steve running through the biggest takeaways from our 1Q23 index results, and I will follow with an outlook on direct lending as we enter a tougher macro backdrop later this year. Please submit questions at any time using the Q&A button on your Zoom toolbar, and we'll answer as many as time allows at the conclusion of our prepared remarks. And with that, Steve, please take us away.
Hey, thanks, Fran. Again, we created the Cliffwater Direct Lending Index as a benchmark for the private debt asset class. We developed it in 2015. We backdated it to 2004. The nice thing about this index is that it was easy to backdate because all the information is with the SEC through documentation sent to the SEC. So it's a closed group of BDCs. We were interested in the underlying collateral or the loans within these BDCs, approximately 136 managers that advise these BDCs. Currently, there are over 13,000 loans within the index, representing $276 billion in loan assets, representing roughly a quarter to a third of the entire marketplace, which is estimated at about $1 trillion. All this data comes from manager filings, 10Qs, 10Ks. These are quarterly filings. So there are really no biases here, no backfill bias, self-reporting bias that you see in other universes. And it's also 100% transparent. For many people that have complained about transparency in private funds, this is just the opposite. There's really 100% transparency. The index, the benchmark, is asset weighted. Okay, both the performance, and then we're going to present some fundamental data, which also is asset weighted, and we report generally with a 45 to 75 day lag. This quarter it was a little less than a 60-day lag after quarter end. We report returns, both the total return, unlevered and gross fee, income component, realized gains, and unrealized gains and losses. We also report a range of fundamental data, which I'll show you samples of a little bit later. We also have two sub-indices to the Cliffwater Direct Lending Index. We have a senior-only index, so, which basically purges the index of second lien loans. And then secondly, a venture debt-only index, which takes out the subset of loans that are backed by venture firms. Those that are interested in venture lending generally focus on the sub-index. Okay. So what are we talking about? What does the index, what is it comprised of? Well, this shows the typical capital structure of a U.S. middle market company. EBITDA of $50 million. That's generally viewed as the average EBITDA for a middle market company. Total enterprise value of $450 million. If you break down how that enterprise value is capitalized at, 180 million represents equity. And then there's financing, both first lien financing, the senior loan, and then the second lien financing. And we've attached market values for the senior and second lien. That's basically representative of the market today. Generally, there are three types of loans in the index. First lien senior loans, generally priced at SOFR plus 5.25%. There's also second lien loans currently priced at SOFR, excuse me, plus 9.25%. And also unitranche loans, which really combine both senior and second lien, priced at SOFR plus 650. Generally, I would say 20% of the index is comprised of second lien. The remaining 80%, roughly half, is true senior, that first lien, and the other half of the 80% or 40% is represented by unitranche loans. All in together, if you look at this bottom comment, at the 5.15% SOFR at the end of March, basically pricing or yield of the index produced an 11.65% yield, plus an additional 2.5% in original issue discount or ID. In terms of long-term performance for the index, we basically report through the main index total return and also three subcomponents, which are informative of how the total return is generated. If you start with the components, the top line, interest income is driven long-term performance, averaging 10.75%. Two possible takeaways. The most persistent takeaway are realized losses. These are defaults less recoveries. They average a little over 1%, minus 1% per year over a long period of time. So you take the interest income minus that 1% in realized losses. We also have from time to time unrealized gains and losses. These are markups and markdowns over time. These will average close to 0%. So basically, it's the economics of middle market loans are pretty simple. Collect the interest income, avoid defaults or losses, and that comprises the total return of the index. Obviously, there are end returns to investors are also impacted by fees, the amount of leverage used within these strategies. But just looking at the loans, our index is focused on just the performance of the underlying loans. In terms of performance ending March 2023, during the first quarter, pretty quiet. Interest income, pretty attractive, 2.74% for the quarter. So that annualizes well over 10% per year. We had realized losses of 25 basis points. If you annualize that, it comes to about 1% per year. That is about the long-term average. So basically, it was a pretty much an average quarter in the context of the long-term history. We had some unrealized gains. Basically, when managers take realized losses, they've already booked some unrealized losses in anticipation. Those are reversed, which produces a positive unrealized gain. In this case, 20 basis points for the quarter. You can see long-term, pretty consistent, pretty boring asset class. Performance ranges between 7 and 10%, pretty consistently over time. We'll look at some short-term periods, but the drawdowns are really pretty modest in this asset class. So, and that's why we think it's the most rapidly growing asset class in the market today. High yield, very low impairments, and a volatility that is falls within a very narrow range, particularly compared to other asset classes. I'd like to focus now on different components of total return. If you look in the deck here, we focus on some definitions. I'd like to just point out a couple of them that you may be less familiar with. PIK, we're going to talk about PIK a little bit later. Payment in kind. Sometimes we'll quote a yield or interest income, and part of that is in the form of PIK or additional principal rather than cash interest. Generally, this is well less than 1% of the quoted yield, but it's interesting to look at the trends in PIK interest over time. Second is OID, original issue discount. Generally, if you make a loan of $100, the lender makes a loan of $100. Actually, they put out on average $97. So basically, that difference or $3 is additional payment that the borrower makes to the lender. That generally is amortized over the life of the loan. In terms of yield, very important, I think, is to understand what yield you're being quoted. There are two commonly used yields. One is current yield, which is interest income divided by price or principal. And the other is yield to maturity, which is interest income plus the difference between the current price and par value. Okay, and that is generally amortized over the life of the loan. Okay, divided by the price. Okay, so if you want to quote a high yield, you use yield to maturity because it bakes in an amortization to par, whereas current yield does not. So in the left-hand graph, we show both current yield and yield to maturity of the index. On the right-hand graph, we do the same for broadly syndicated or levered loans. Notice the scales are the same. So both yields for the CDLI generally fall about 5% higher for the middle market loans compared to levered loans. Looking at current yield and then yield to maturity, but let's start with current yield. Here we're showing current yield across the CDLI, the Bloomberg High Yield Bond Index, and the Morningstar LSTA Levered Loan Index. And basically, we do this just to show, just using current yield, on average, there's well over a 5% yield delta advantaging the CDLI or middle market loans compared to broadly syndicated loans. That same differential exists if you're using yield to maturity calculations in the bottom chart. Again, the average well over 5%. These spreads can vary over time, almost without exception. The CDLI has the highest yield by far across the three non-investment grade categories, but they can become compressed, particularly during times of stress. And so that spread has narrowed a little bit over the last couple couple quarters, primarily because, as I'll show later, the price of levered loans and high yield bonds is currently several points, 5 to 7 points below par, whereas it's only about 2 to 3 points below par for the index. Against treasury bills, so oftentimes in finance we talk about the risk premium or the reward compared to the risk-free rate. So basically here we show trailing 4-quarter interest income versus for the index versus treasury bills. And again, you can see very healthy premium, risk premium for this asset class. But quite honestly, more as attractive, if not more attractive, than publicly traded equities. Let me leave interest income. Let me focus on realized losses. And what we often say is when we do due diligence on underlying lenders, our focus is on realized losses, because that really is the alpha that lenders can provide, avoiding defaults and consequently realized losses. So this is a chart that shows realized losses over time, trailing 4-quarter. You can see in these bars, it's cyclical. Obviously, losses picked up during the great financial crisis. We had an oil crisis, if you recall, back in 2015, 2016, and then we had COVID. So cumulative realized losses are depicted by this line. So over the almost 20-year history of the CDLI, there's been about 17%, 17 to 18% in realized losses for the index, translating into on average 1.04% in losses per year. Wanted to show those losses in comparison to other asset classes. So in this chart, in this third column here, we show average annual losses for high yield bonds at about 1.5%. For levered loans, a little less than 1%. For the CDLI, just a little more, averaging about 1%, so very close to levered loans. We're also added here the U.S. banks on their balance sheet, commercial and industrial business loans. Those have averaged between 1.2 and 2%. So highest risk arguably is within bank balance sheets, followed by high yield bonds, followed by the CDLI and levered loans. Focusing on unrealized losses, I'd like to spend just a little bit of time on this chart, because I've said over the years that unrealized losses really should be thought of as a loan loss reserve for future defaults. And it's just like banks. Banks, in terms of their accounting, they set aside these loan loss reserves, and then they credit against them realized losses or actual impairments. So if you think about that, and you think about middle market loan valuation as represented by the CDLI, notice there were significant unrealized losses or markdowns just before, during the financial crisis, which preceded the actual realized losses over the subsequent 2 to 3 years. And the key observation I've made in the past is those unrealized losses, or that loan loss reserve, kind of overestimated actual losses. So it's, people talk about valuation, but actually, if you think about valuation the way I do, valuations are actually conservative. In other words, they mark that portfolio down more than they need to cover subsequent realized losses. And that was also true during the oil crisis in 2015. okay? And also true during COVID. So these the valuations that come to us quarterly through independent valuation firms seem to do a really good job, if not overestimating subsequent losses. Let me turn now to total return, just a couple of representations of total return. So looking over time, this is rolling 4-quarter, so rolling 1-year returns. We consider this pretty attractive. The average return for the CDLI, 9.46%, but you notice a pretty low volatility, for an investment asset class, pretty low volatility around that long-term average. And on a 4-quarter basis, the only time we saw negative returns was during the great financial crisis, which we've described as a three sigma event. So my point is two sigma event that the oil crisis represented. COVID was largely a 2 sigma event. Basically, we still earned positive returns in this asset class. And then I also wanted to show calendar year returns. Again, the 3 asset classes or indexes we've been talking about, middle market loans, high yield bonds, levered loans. I added here investment grade bonds, the Bloomberg Aggregate Bond Index. And I've highlighted what index did the best in each calendar year. Two things stick out. One is the CDLI regularly outperforms all the other asset classes, not always, but most of the time. The second is levered loans, broadly syndicated loans, never are the top performing asset class. And if you look at the bottom, whether you look at 10 years or from inception, the CDLI shows significant added value vis-a-vis these other indices. So the lesson is, hey, with your private debt portfolio, if you can meet or exceed the CDLI, which is our objective with both institutional clients and non-institutional clients, if you can do that, you're going to add significant value above a traditional fixed income portfolio, investment grade or non-investment grade. Other characteristics wanted to point out, I've shown this in the past, non-accrual rates. So these are loans that are defaulted, and we show the average for the index. If we start, I focus on non-accruals at cost value. So in other words, as a percent of principal value. Currently, it stands at about 1.5%. That's still well below the historical average of 2.16%. So basically, the index itself, from a non-accrual default perspective, is healthier than the average over almost a 20-year period. Also, the recovery rate. If you once a loan defaults, what do you get in recovery? It's still standing at about its historical average. So the marketplace is, from my vantage point, pretty healthy marketplace from a portfolio statistics point of view. I did want to note that, as I've pointed out in the past, the index is becoming more senior over time. Currently, 79% is senior secured, whereas during the financial crisis and before, senior secured loans represented less than half of the index. One kind of remarkable change over the last couple of quarters is the effective life of these loans. And the stated life maturity is generally 5 to 7 years for a new loan. Corporate action kind of reduces that significantly because M&A activity has been low. The effective life has increased to almost 5 years. So you're not getting as much cash flow out of the portfolio as you would on average, in terms of effective maturity. I will say interest income this has been somewhat offset by higher interest income from higher credit spreads and higher SOFR. Well-diversified index, I won't talk about that. Still, information technology, healthcare are two of the largest industry sectors within the CDLI. In terms of pricing, current pricing is close to par, but there are some differences. It's typical during a period of distress. CDLI has the highest price at 98, followed by 93 for levered loans, 88 for high yield bonds. High yield bonds are trading at a much more of a discount because they're fixed interest with a 5-year average life, which because of the rise in long-term rates is also depressing the price. In terms of within the CDLI, we show pricing for senior, subordinated, and other being primarily some structured notes with a little bit of a equity composition, particularly within venture loans. And as you'd expect, senior secured has the lowest level of volatility. I mentioned PIK income earlier. PIK interest normally during periods of stress, like during COVID, PIK interest rises. It's been pretty stable over the last few quarters. So again, we're not seeing indicators of stress. So that recession that people talk about, that Fran will talk about on the horizon, other than some unrealized losses that have built up, markdowns, building up the loan loss reserve, and using my analogy. Other than that, we haven't seen the index display indicators of stress. In terms of, we report this in our quarterly write-up, but basically over the last 4 quarters, senior secured loans have done 7.12% against the overall index of 7.26%. So senior loans have short-term performed pretty much in line with the overall index. Long-term, the overall index has done better than the senior index, but the senior index has lower risk. It also, when you put a portfolio together with financing, it's easier to get financing with senior loans. So basically, pick the strategy you want, but basically senior with financing generally does as well as the overall index. In terms of venture, we show here the performance of venture versus the CDLI, pulling that out. Venture has done pretty well for a lot of our clients. We include a component of venture lending, and it continues to do well. So with that, let me turn it back to Fran to look ahead. Go ahead, Fran.
Yeah, thanks, Steve. So over the past 6 to 12 months, there's been enough negative headlines and exogenous shocks to the broader markets, obviously giving investors good reason to be highly cautious and risk averse. But meanwhile, through all these events, including Russia-Ukraine, severe inflation, unprecedented rate rises, a disruption in the syndicated loan and bond markets, and now topping it all off with a recent banking crisis, direct lenders have kept their heads down, and they've continued to advance the ball down the field. But amid so much uncertainty, coupled with renewed recession fears, we are getting a lot more questions on how the asset class will navigate over the near to intermediate term. Steve highlighted earlier how returns have remained strong, but we also want to highlight some reasons why many market participants remain bullish on private debt and are staying the course despite the uncertain macro. And so turning to the next slide, we can start by discussing the direct lender's deal flow advantage. We talked about this a few weeks ago on our 4Q22 CDLI webcast, the deal flow market has become very challenged in 2023, and it is unlikely that we're going to see a deal flow boost return to its 2021 peak anytime soon. The math for private equity returns has become increasingly challenged, and it is slowing deal flow. This is being driven by a combination of rapid rate rises, slowing revenue growth, margins are getting squeezed, underlying customer demand is softening in several industries, the cost to refinance is at all-time highs, and leverage levels are being reined in materially due to cash flow dynamics. But despite that all happening at once, it is still paramount for private equity shops to return liquidity back to their LPs and generate strong IRRs. But as you can see here in the chart on the right-hand side, the easy money of the syndicated market is now a thing of the past. New money institutional issuance in the loan market has shown a steady decline month after month for over a year now. Now, of course, the syndicated market is not going away anytime soon, and it will come back at some point. But we need stability in the markets and the underlying economy for that to happen. And so many sponsors and borrowers are turning to the direct lending market with increased frequency to help finance exits, pursue refinancings, and help them push along their borrowers' growth agendas. While direct lending volume in the chart on the left did see a material slowdown in 1Q23 as well, there are specific types of financings that direct lenders have a very real competitive advantage on right now at the current moment in this market that is helping to build up the pipeline in recent weeks and through the balance of this year. First, that includes add-on acquisitions and roll-up strategies as usual, which are crucial for sponsors so they can continue their EBITDA expansion thesis on portcos. Second, the market is starting to see more refinancings on credits that do not want to stay publicly rated anymore. Many borrowers have rating fatigue. They might be strapped to refinance, particularly when older CLOs are past their reinvestment period, or investors within the bank group are unwilling to step up due to rating pressures. Third, we're seeing a material pickup in public to private M&A deals or corporate carve-outs, deals with a long lead time to close. The investment banks are being ruled by their risk committees right now, and taking material pipeline risk is harder for them to get comfortable with. And lastly, those borrowers that are in need of flexible and creative financing solutions. For example, adding PIK components to their financing structures. Direct lenders have more creative and flexible capital and pockets where they can hold these types of structures versus the CLO market that does not. These are just a few examples of very real deal flow advantages for direct lenders, and these trends are going to continue for the foreseeable future. Now, flipping to the next slide, we can discuss the attractive yields and strong risk-adjusted returns the direct lending market has experienced as of late. In fact, many market participants are saying that relative value has never been as strong as it is today, as both doc terms and covenants are tighter. And despite a shortage of supply market-wide, we have not really seen yields or spreads tighten materially because of it. Yes, there's been some pressure on pricing and leverage in the last few weeks, but really it's been on the margin. And this highlights that direct lending capital is highly sought after, and these lenders can continue to have the upper hand on terms, which is often not always the case in this asset class when you go back through time. The chart on the left highlights new issue yields on B-rated institutional loans in the light blue versus first lien direct lending transactions in dark blue. We can see the healthy illiquidity premium that direct lenders have maintained in the last 3 quarters. And even when deal flow slowed in the first quarter, direct lenders continue to push yields and spreads higher, while the institutional loan market saw tightening due to a supply-demand imbalance. Meanwhile, the chart on the right illustrates that structures have become more conservative. Loan to enterprise values were around 45% a few quarters ago. That has now tightened further to 40%. And this tightening has occurred even as purchase price multiples have come down. So that's a material decrease in leverage levels on new deals, with sponsors filling the gap with even more equity than they have in the past. And these yield and structural benefits are not just on new deals. Even existing loans in older vintages within direct lending portfolios are seeing spreads reprice higher due to MFN provisions as sponsors come back to do add-ons. And you've heard many managers on recent earnings calls highlight their ability to increase spreads on deals while tightening the docs and the incurrence tests on structures. And we're finally starting to see that show up in the 2023 figures with all that income benefit getting passed on to the investor. Now, moving to the next slide, we can discuss the defensiveness of portfolios. You've heard many direct lenders say it, but I think these charts really show it nicely. Direct lenders are buy and hold investors. They are now putting a very heavy emphasis on building through the cycle portfolios with each passing year. If we were to go through and label the most common sectors within CDLI based on the cyclicality of their cash flows, we can see that direct lenders have been slowly rotating portfolios away from heavy cyclicals such as energy, leisure, construction, and heavy manufacturing to more defensive, higher margin, and through the cycle performers such as software, healthcare, and businesses that continue to have steady demand regardless of where we are in the cycle. This combined with the rotation away from junior capital to first lien heavy portfolios, as Steve highlighted earlier, will ultimately result in a better outcome within our CDLI index returns compared to prior downturns. And then turning to the last slide, we can't ignore the default outlook. The good news is that the strong performance to date for direct lending is showing up in a lower default stat when compared to the broader markets. Of course, the biggest concern on direct lending and in the loan market in general right now is portfolio health and where will it trend over the next 12 months. Many folks are asking, are we going into a recession? Can borrowers withstand the elevated base rates coupled with slowing growth? Looking to the chart on the left, this shows the TTM default rate within the index back 10 years. It's a little bit different than the non-accrual chart on outstandings. This shows new loans put on non-accrual with each quarter. Steve addressed the spikes we saw earlier in 2016 and 2020 based on energy, junior debt concentration, and COVID. But the most recent LTM default rate within the CDLI as of 1Q23 stood at around 1.44%. This is lower than what we're seeing in the high yield bond and institutional loan markets graphed on the right, which is already in the 2% plus area. And as we look at the forecasts by the rating agencies here on the right, we're expecting to see credit downgrades in the broader market, a rising default environment, and a tougher economic backdrop to come. Of course, we know smaller borrowers are just as vulnerable as larger ones, particularly when base rates are elevated. But direct lenders do have a lot more tools they can utilize to ward off defaults, and so you may not see the same level of spike in direct lending portfolios as the broader market. Things like covenant holidays in exchange for sponsor support, maturity extensions, toggling a portion of a loan to PIK instead of cash interest can all be easier to execute in smaller direct lending bank groups. Direct lenders move faster. They get in front of the borrower and the sponsor faster. They have better reporting. And getting sponsors to put in equity is also more common given the relationship aspect and being higher up in the queue compared to the institutional market where you have 100 CLO managers in your bank group. Furthermore, we are starting to see a lot of structured capital, such as PIK preferreds, come into some of these capital structures. These structures and debt instruments help alleviate the cash flow burden on borrowers and provide necessary liquidity without burdening their cash flows. There's also substantial amount of dry powder, both within direct lending and private equity to step in and support these borrowers. And that's a big difference from where we were during the GFC. Furthermore, selling smaller companies that might be struggling is far more palatable than figuring out what to do on a large multi-billion-dollar syndicated corporate borrower that can't access the IPO market or find buyers large enough to absorb them. This will ultimately result in better recoveries for direct lenders versus what you're seeing in the institutional loan market. And lastly, direct lenders have more experience in workout capabilities today versus what they had 5 or 10 years ago, when we had a slew of newer players with less reps and less defensive portfolio composition. Yes, we still have new platforms coming into regular way direct lending every day, but many of them have prior track records at different platforms with workout and operational experience in other parts of the market, such as distressed, opportunistic, and private equity. So case in point, the institutional knowledge that has come into this space, the long track record, the abundant levels of cash, and the locked up capital is all going to help this asset class navigate what's ahead in the next 12 months. And so we're going to stop there. I'm going to turn the presentation back to Steve, and we can answer any questions that have come through.
Hey, thanks, Fran. We have a couple questions, and just a reminder, any late joiners, if you have a question, just enter it in the Q&A drop down on your on your terminal. I'll take the first one. I'll throw the second one to you, Fran. The first question is, I said that the loans in the CDLI come from the underlying collateral within BDCs, representing about 25% to 35% of the entire market. The question is, hey, is this representative of the other 2/3 or 75% of the market? And our answer is yes, primarily because of regulation. So basically, if a lender underwrites a loan, that loan is put in pari passu across their accounts. So whether it's their private funds or SMA or within the BDC, if all those vehicles are under circumstances where they can take loans, basically it's pari passu. So we believe it's very representative of the 100%. And, we feel that it's almost a pure pure sample, unbiased sample of the entire universe. Okay. Second question, maybe you can handle, Fran, is I talked about PIK income earlier. Let me see if I can pull that up. So PIK income, I mentioned, is pretty much changed over the last few quarters, but it's still higher than kind of an earlier period, 2012 to 2019, where it seemed to be at about 5%. So is that a reason for concern? Is it on your part at all?
Yeah, so that's a really good question. And you can see during periods of stress, the PIK percentage goes up because it is a very prevalent workout tool to help give borrowers runway. But post-COVID, this elevated level of PIK really wasn't driven by workout situations. It was driven by, in some situations, you did have a lot of lenders on certain borrowers structure loans out of the gate with a PIK component on some of their first lien debt. You could see that on ARR loans, because ARR loans typically don't have cash flow right out of the gate. They grow into their capital structure. So the prevalence of those has contributed to it a little bit. But also the big reason that you see an elevated amount is a lot of these direct lenders do have PIK preferreds in their BDC portfolios. So if we went back through time, direct lenders were very heavy second lien and mezz to get their returns on top of the first lien. As we've seen a lot more lenders gravitating into first lien in their portfolio, they have been juicing their yields a little bit instead of doing mezz and second lien, layering in some of these PIK preferred equity type instruments into their portfolio, which tend to have actually a higher return than you would get in junior debt. So they are equity-like positions that are getting incorporated in the interest income or the investment income portion of the direct lender's financials. And yes, if we do see PIK go to very elevated levels, the big concern is, can the managers meet their dividends, basically, because you still have to pay out 90% of your income. So you want to ensure that you're managing the level of PIK within your portfolio. So if you're looking at different direct lenders, that's a great question. If you see certain direct lenders have a heavier amount of PIK out of the gate, what's their dividend policy and their dividend coverage?
Thanks, Fran. One other question, let me read it because it's a late arrival here. Assume the trailing 12-month default rate shown on 33 is not for the CDLI, just the non-accruals are right, because most BDCs don't report default rates. Assume Fitch.
I could take it, Steve.
Okay, go ahead. Thank you.
So on page 33, you're talking about the chart on the left. You're right. We actually calculate that. We have tools to go borrower by borrower to see if a loan is placed on non-accrual in the March 31st quarter that was not on non-accrual last quarter. So we go line item by line item, borrower by borrower, and sum up how many loans were placed on non-accrual. So you'll see on that chart, there was about $1 billion of loans last quarter that were fresh non-accrual loans. So we take that over the 4-quarter period, and then we divide it by just the debt instruments outstanding. So we strip out equity. Yep, there it is. So $1 billion of new loans were added to non-accrual. And then we add up the previous 4 quarters of that figure and we divide by the average debt outstanding within the index. We strip out equity, and that's how we get the default rate. So it's going to look very similar to the non-accrual rate, except this is going to be fresh defaults new for the quarter, as opposed to the non-accrual chart Steve showed earlier is what's on non-accrual status on outstandings at a point in time. So they're a little bit different, but they're going to show the same trend.
Thanks, Fran. Not seeing any other questions. I'd like to thank everybody for attending. Our next presentation on the index should be in late August. If I don't talk to you, have a great summer. Thanks again. Bye-bye.